I think when we look back at the end of this year, I think 2026 will look like a continuation of the bull market that started in 2022, but and really a period when economic resilience is much more visible. But at the same time, there's two, I think, substantial transitions that the market has to grapple with. Maybe three. One is, of course, a new Fed. And, the market always tests a new Fed. And that process of identifying and then confirmation plus the market test can create a correction. And I think that in 2026, our view is that the White House is going to be more deliberate in picking winners and losers. In 2025, that caused a lot of disruption for technology, IT consulting, and for healthcare. And this year, there's a lot more industries and sectors and even countries in the bullseye. And I think that creates uncertainty. You can tell by gold's rally. And so I think those two factors can cause a drawdown in 2026.
Those two factors, you said maybe a third.
Yeah. So the third is that the market is still trying to understand how much is priced into AI. And so our view is still a strong narrative. But as you know, there's questions about the longevity, how much energy we really need, data center capacity. And so until the market is comfortable that there's other stronger narratives, which I think there's plenty, like the ISM is turning up, I think housing could recover as rates are cut. But that transition, again, would cause uncertainty. So I'm guessing that the three collectively could cause a drawdown that feels like a bear market.
Tom Lee is painting a big picture roadmap for what's coming next for the market. The bull market isn't over. It's evolving. When we look back on 2026, he believes it will feel like a continuation of the rally that began in 2022, backed by an economy that's far more resilient than most expect. But this next phase comes with turbulence. First, a new Federal Reserve. Markets always test a new Fed. And that transition alone can spark sharp corrections as investors recalibrate expectations. Second, a more interventionist White House, openly picking winners and losers. We've already seen the fallout in tech consulting and healthcare, and now more sectors, even entire countries, are in the crosshairs. That uncertainty is exactly why gold has been surging. The third wildcard is AI. The story is powerful, but markets are questioning how much growth is already priced in from energy demand to data center capacity. Until new narratives fully take over, volatility remains. From my perspective, this appears to be a classic mid-cycle shakeout, volatile, emotional, and unsettling, but not the end of the bull market. Instead, it looks more like a necessary reset before the next sustained move higher. Tom Lee also alludes to the possibility of a decade-long bull market, suggesting that last year's tariff-related volatility and the October 10th pullbacks could ultimately be remembered as major buying opportunities, particularly for Bitcoin and the broader crypto market. Now, let's get into the details from Tom Lee. Remember, liking this video goes a lot further than you think. It's one of the best ways to support the channel. Drop a comment, subscribe for more insightful breakdowns. Let's get back to more clips from Tom Lee.
So implicit in that is what, like a 20% peak to trough pullback or more or less?
Yeah, it could be 10. I mean, if it's 10, by the way, it's going to feel like a bear market, but it could be 15, it could be 20. But something that maybe brings us to a round trip from the start of the year, because we've started off strong. Maybe we'll be down year to date at some point, but then I think we really finish the year strong.
So when we spoke in August, you said that we were at the start or close to the start of a 10-year bull market. Is that's still your outlook? I guess another way of saying that is once we've had that pullback, you'll be banging the table and saying this is a fantastic buying opportunity.
That's right. Every pullback has been a great opportunity. Last year, the tariff-related drawdown was on April 7th, turned out to be one of the best entry points in the last 5 years for anyone buying stocks. There were so many stocks that made new all-time highs, but really explosive rallies. So I think this year, if what we think happens, it's going to be a great buying opportunity.
So clearly the long-term bull market thesis you're still a big believer in after a pullback. How do we sort of try and get as good a feeling as ever about when that initial pullback comes? I was listening to one of your recent appearances on CNBC, and you pointed out that markets peak on good news, somewhat counterintuitively. Have we got that good news at the moment that would point to a short-term peak?
It's hard to say. And this is somewhat anecdotal, but our institutional clients aren't that bullishly positioned at the moment. And until we get to the point where both the public and institutions have positioned in a way that good news doesn't make the market go up, I think stocks still have upside. That's why the fact that stocks were good in the first week of January is a good omen, and it looks like we're going to finish the month positive. That suggests strength in the early part of the year. Margin debt is something we can watch, and we've been tracking it. NYSE margin debt is at an all-time high, but it's only risen 39% year over year. Usually for a local top for markets, you want to see that rise 60% year over year. So there's a chance for essentially leverage to accelerate, and then that marks a local top.
Let's touch on some of the kind of macro factors then. I guess let's start with trade, because I know one of the things you were sort of saying last year was the trade war didn't turn out to be as bad as it could have been. Over the weekend, more threats of tariffs linked to Greenland this time on the UK and the EU. Looks like the UK is going to fold. The EU might retaliate. Is that a worry for you in the short term?
Yes and no. I think that last year, investors did a fire-ready aim. Whenever they saw the tariff conversations escalate and become uncertain, the market really reacted poorly and fell sharply. I think that this year, markets are going to be a little more measured. So let's say it's half the amplitude of reaction. But then there is still the uncertainty of how the Supreme Court will rule around the tariffs. And maybe if that rules against Trump, then it's going to look like the leverage of the U.S. has dropped, and so the White House might take more extreme measures. That could cause greater uncertainty. But over the weekend, I've been reading the news. I mean, there's some folks suggesting the Supreme Court might actually rule in Trump's favor. So I really don't know.
In terms of the other sort of big macro question about the Fed, ironically, when we spoke in August, it was in and around attempts to indict Lisa Cook. Obviously, more high-profile attempted indictment this time around. Generally, your view then was Fed cutting is a good thing for markets, but questioning Fed interference is a bad thing for markets. But I don't think you took the idea of interference that seriously. How do you sum it up today, that outlook?
I think it's still the same situation in the sense that there are implicit threats being made against the Fed, including this DOJ inquiry. But I think there are still voices in the White House that are kind of saying, let's not undermine the Fed completely, because markets know, and market history knows, that the Fed is still the most important entity in the world. And to undermine the credibility and the independence would unleash a lot of uncertainty. We also know Fed Chair Powell's term is up this year. So there's a bit of like, let the clock run, because we know that there'll be a new Fed chair. And I think once we have that in place, I think the White House can be satisfied. And as you know, who the next Fed chair can be, I mean, the odds keep shifting. Now it looks like Hassett has dropped as the probable, and Warsh and even Rick Reed are ascending. So,
and I guess everyone expects slightly more cuts than maybe the data would purely suggest once that change happens, and/or a few more cuts this year. Is that a good thing ultimately for equities?
Yeah, I think it is good for equities in the sense that inflation has been the market's fixation since 2022. Part of it, of course, is because the Fed has been fighting an inflation war, and the Fed wants to maintain credibility by being tight. But when I look at the economic data, and I'm not an economist, I think the underlying inflation is actually much lower than the printed. I mean, simple thing to point to is something like Trueflation, which is showing 1.8. If you look at median inflation, it's at 1.8. And the thing that's keeping inflation high is housing costs. But housing prices are falling. So the way that housing is measured in CPI is with a lag. So to me, I think there is cover for the Fed to cut. And if housing, as you know, affordability is a problem, we need to do something about mortgage rates. And that is helped by cutting. And even things like consumer installment debt, those can come down with rate cuts. So I think burdens on a lot of Americans can actually ease with Fed cuts.